means buy. Call option gives the buyer the right but an obligation to the seller. It is an option to buy the stocks at the pre-specified future date. For example, today I have entered in a contract for 100 rupees. If the price goes down then 100 rupees, then I will lapse the option May 31st. If the price goes up then 100 rupees, then I will exercise the option, means I will buy the option on May 31st. To enter into an option, buyer has to pay the amount to the seller that is called premium. Let us take an example, the premium be 4 rupees. These 4 rupees will not be refunded to the buyer again, whether he lapses the option or exercise the option. That's it.
What is a bond?
Bond is a debt instrument. Bond is a debt instrument where the investor buys the bond today at the market price and the company pays the coupon rate for every year up to the specified number of years. And on the maturity date, you will get the redemption value. For example, Government of India 7% of coupon rate for 10 years. Every year you will get the coupon rate of 7 rupees and on the maturity date you will get the redemption value of 100. The issuers of bonds are governments, state governments and corporates. The bond can be traded in the market as an equity share where we can see the open, high, low close for the bonds. Bonds are debt instruments, hence they must be rated by a credit rating agency.
What is the difference between primary markets and secondary markets?
Primary market is a first market and secondary market is a secondary market. Primary market is a market where issuer or company issues the shares to the investors. Then the investor will buy those shares. This is called primary market. Whereas secondary market,
Investor sells the share to another investor. That is called secondary market. The market participants in secondary market are stockbroker, stock exchanges, trading members, clearing members, and stockbrokers
and traders. The market participants in primary market are merchant bankers, book running lead managers, company, and promoters.
What is a mutual fund?
Mutual fund is a collection of funds. Mutual funds is a pool of money mainly collected from retail investors. There are 45 mutual fund houses in India with over 1,500 schemes. Mutual funds mainly collect money from small investors and invest in stocks or bonds or both. Mutual funds are divided based on portfolio management, entry and exit, and returns. The main two advantages of mutual funds are diversification and professional management.
What is an open-ended scheme and a closed-ended scheme?
in open-ended scheme we can buy or sell at any time. In closed-ended we cannot. Open-ended scheme. Open-ended scheme is the scheme which they buy the units with the investor on a daily basis at a prevailing NAV. For example, you invested 10,000 units and the mutual funds give some units to the investors and the number of units given to the investor will go up. And if anybody wants to redeem the shares, they can go to mutual fund and fill the redemption form to get the money back from the mutual funds, and also the mutual fund will buy back the shares. Closed-ended. It means that mutual fund will not buy or sell the units at any time, but however, it is traded on a stock exchange as same as an equity share where an investor can buy or sell the units. Once the trade is done in the stock exchange, the mutual fund house will remove the seller's name from the register of unit holders and add the buyer's name. In case of an open-ended scheme, the units keep changing every day, and in case of a closed-ended scheme, they do not. And that remains same for a fund's life.